Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Econ Show, we're going to look at global supply chains, emerging markets, inflation, and then we're going to go deeper into what are some of the recent PMI numbers, what has the Fed been saying, and then trying to answer the unemployment question, and then we're going to go into some existing home sales, housing inflation, and then wrapping up with European data. Where is it leading us? What is it telling us going forward? And then an Asian update just in terms of some of these missing data points. So just trying to keep consistent with the EIA show and some of the feedback that we've gotten, I'll try to sum up some of the key points. Right now when we look at supply chains, they continue to get worse. There's a stretch that remains the biggest problem just in terms of where we are on the unloading side, the loading side, so on both sides on the shore, and then in between when we're looking at just where those issues are on bottlenecks, on ship availability. And we continue to see that be a huge driver in terms of delivery delays and increased pricing. Now, when we look at employment or unemployment, the easiest mantra is, well, it's because of the extended benefits. Well, it is and it isn't. So when we look at some of the different backdrops of it, well, we've had an acceleration of retirement. We do have additional benefits. So is it worth getting paid $18 an hour to sit on the couch or get paid $20 to go into an office or to do a job? Is that $2 difference worth it? And then on the other side, it's skills. Because when you are a company and you're looking at this and saying, okay, well, there's a huge pool of people available, so I can either hire this individual sitting in front of me, or I can wait for somebody better, somebody that meets my standards, because there's still 10 million people unemployed, 15 million people unemployed, depending on the number that you use. And then from the employee perspective, they could say, well, there's all these jobs available. I keep hearing how all these jobs are, and this doesn't really fit. I'm going to wait for this one. And you keep getting this pushback where neither side can come up with kind of what they're looking to do. And then when you look at participation rate, well, maybe participation rate is wrong. And for those that have been in the job market, I myself have been one of them over time. How many times have you gone to a jobs board, you've gone through the 3 rounds, and then the job disappears, or the job is filled internally, or they're no longer going to fill that job, or there's a hiring freeze? So there's also a certain amount of, because it is much easier to put a job on the market, and how many companies are using that to see what is the going rate, what should we be paid? And then at the other side, now those are some different pieces. On the last piece, there's also supply chain issues. So if the supply chain is short, well, I can't continue to make this product, to make this widget, because I'm missing parts D, parts G, and parts Y. So even though I have all the others, because I'm missing 3 key pieces, I'm going to have to shut down, and somebody's going to be furloughed, or I'm going to delay hiring. So these are some of these caveats that we continue to see. But the first thing that we really want to look at is when we turn to emerging market inflation, and really kicking off it more importantly with the Iranian deal. Where do we sit now that we're on the other side of the presidential election? So let's just look at increased movements of emerging market inflation. So I think this is a really good breakdown of where Brent, looking at crude, food prices, and then really, the main components of inflation. When you look at what has happened with Brent and how rapid the increase in prices has been, it's easy to kind of get overwhelmed by like, well, this is going to be instantaneous. And now, Saudi Arabia is coming out and saying that they are also, or OPEC should have some responsibility with managing inflation. When you look at where Brent prices are, where gasoline and petrol prices and diesel prices have gone. India has seen a record. Now, mind you, it's not all Brent, it's not all crude, it's also spreads and taxes and other things. But this is going to be the quickest and easiest punch because many of these countries are beholden to the import price. where food is kind of that slow burn, where, it starts out slow, there's a lot of subsidies on top of it, but as you continue to see these price increases, and now while prices have moderated, we have significant droughts, which we'll talk about. We have significant delays, which are continuing to make these problems worse. So even though it's been slow to rise, there's a lot of momentum behind it that is going to keep that pressure going. And then when we look at those first principal components, or some of the other components that we continue to see, even though there's been a rapid move up, a lot of these moves up are fairly sticky, and that's where we were very early to the inflation discussion, calling it out as a going concern and a coming problem. Received a lot of pushback on it, but here we are, and now it's what comes next. And it's not really deflation or a moderation of pricing. It's more of a stagflation. It's this sideways move, which is still not good for anyone, because when you look at just the underlying impacts it's had for a lot of these emerging markets and a lot of these markets in general that require or a lot of borrowing or a lot of stimulus that we've seen to try to get people to the other side of COVID, this is going to, again, create more problems, which will also put kind of that sneaky bid within the U.S. dollar in the near term, as some of these emerging markets try to cover some of their inflationary fears and keep the market calm while they continue to borrow and try to stimulate their economies. Now, some of the talk comes from Iran as being tough, like, unless the U.S. does this, we're not going to have a discussion. People want to stay in power. When you're in power, you want to stay in power. And that's the way it goes. That's why the U.S. and a lot of these other developed markets are unique, because there is a natural changeover or historically has been a natural changeover or a peaceful transition of power. So when you look at Iran, a hardliner one, they want to talk a good game. They want to say, we're not going to pay attention to the U.S. We're going to be tough on everything that's happening right now with the nuclear deal. But there's also the reality, and the reality is economic. You don't want to risk a more social upheaval, more protests and risks. You need to adjust to try to mediate some of the underlying risk, which is on the economic level. The government has had to turn aggressively to the debt market as sanctions increased. When you think about when President Trump got rid of left the nuclear deal, here's where the debt had to increase exponentially in order to close some of those gaps, because Iran just wasn't going to make the same type of money, because all of their products that they were selling were going to have to circumvent sanctions, which were a risk to the international market. So that means that their crude and their refined products and their liquids was always going to be priced at a steep discount. So now, while this is happening, and now there's shortages, there's a black market opening up, and that's where you start to get this inflationary pump, because the Iran's economy fell well below the rest of the Middle East and the Central East Asia. When you look, and it's not, even though there was a deal, there really wasn't a closing of this gap. There was this wide divergence that happened when the sanctions were increased. Even when President Obama signed the deal, they never really had a chance to kind of catch back up. And it's really because not only did they have these slowdowns, but there was also the inflationary problem. Inflation has been a consistent issue within Iran, and this has led to additional upheavals. The lone nuclear facility that is there had to go into an emergency shutdown because of some problems within their control system. Hint, hint, more additional attacks within the country. And so even if we get some sort of nuclear deal, which at some point Iran is going to have to yield, because they can't keep going at this rate and assume that they're going to stay in power. And the U.S. has to recognize that the longer the stress goes, the more disenfranchised people will get, and hopefully there will be a drive for more change, because there was a decent amount of individuals who already said that this was a tainted election. They refused to participate. So there was a certain amount of boycotting as well. Now, when you think about this disparity, this is where we continue to talk about the inflationary side. So you can see this big spike that happened. Then there was the signing of the nuclear deal, which brought that inflation under control. But it still ran hotter than the rest of the Middle East and Central Asia. And then as things devolved and the U.S. Got rid of or left the nuclear deal, you can see the inflation hit an all-time high and continues to track at 40%. Again, black markets, shortage of dollars because all of these sanctions happen in terms of dollar movements, so you can't utilize the dollar in order to trade with Iran. These are the types of things that they may talk a good game, but they need this deal more than pretty much anybody who doesn't. I mean, if you think about China gets cheaper goods in terms of LPG, liquids, oil. The market in terms of where their product goes gets cheaper goods. So they're not going to want them to have a deal, even though technically you'd say that they may want to. But this is why Iran is going to be forced into, or is going to have to make a deal that may be viewed as not something that was that they wanted or against kind of the code of the hardliner. But this is where they're going to have to be pushed to make a decision, especially if they want to stay in power. So now when we look at some of the gaps in the underlying chips market. We've been talking about how bad some of these chips are, the shortfalls, how the shortfalls continue to get worse. And here's an update now where we are currently at 18 weeks. Before it's gone from 16 to 17. Excuse me, and now to 18. And it's unlikely this is going to stop just because the drought that we've been talking about that has hit, as we highlighted in Taiwan and in China, is also reducing the amount of electricity that's available in Taiwan and South China, which is also impacting their ability to manufacture, especially microchips, because they require a significant amount of electricity to do and water on a chip-by-chip basis. So these issues continue to extrapolate, continue to impact, and it's unlikely we're going to see any type of this catch up with itself before the end of 2021. Now, this is also driving policy. So when we look at policy, so on Thursday, Bloomberg talked that Xi has tapped Vice Premier Li to lead China's drive for semiconductor self-sufficiency. Li is tasked with overseeing the development of China's third-generation semiconductor industry. Third-gen chips, which use complex chemical processes to supercharge performance, are a relatively underdeveloped corner of the chip space. And if you think about the amount of petchem China has brought on, the amount of refining that they've brought on, this is a natural step because China has always wanted to be the leader in chips because this is the largest import. So when you look at Huawei, before U.S. had sanctions, they ran out and stockpiled chips. It's going to be the easiest way to sanction China, and they want to get ahead of that. So China is by far the world's largest importer and heavily reliant on increasing fragile supply chains that include the U.S., South Korea, and Taiwan. As I've said, they do not have the best relationship, as the U.S. just traversed again the Taiwan Strait, and China came up and said, they reserve the right to defend themselves, and they essentially just came out and threatened the U.S. because we transited the Taiwan Strait, which comes on the back of us landing some ex-senators within Taiwan to talk about the politics, and that was viewed as a bigger provocation, very provocative by China itself. So on the other side, Washington has already placed export controls on numerous Chinese tech firms and chip makers and continues to urge allies to follow suit. Last week, the U.S. Senate passed a $52 billion spending package to promote its own chip industry, which we've been talking about, where the U.S. is looking to become self-sufficient. We've heard it from Samsung, Intel, Taiwan Semiconductor looking to build within the U.S. as well. The choice of Liu is a no-brainer for Xi, as he already oversees China's technology development, and he's an old friend of Xi and is a trusted economic advisor for him. So again, these are things that are essentially become a positive for China to try to adjust some of these supply chains. But when we look at U.S. semiconductor exports to China, they continue to surge. So even though we have sanctions, we have semiconductor exports still remain elevated to China, but this is slowing. And even though it's still elevated, China's trying to get ahead of this coming collapse. And you can just see the inherent growth because demand continues to go up because it feels like everything from sneakers to light bulbs at this point have some sort of microchip and connectivity into it, which is keeping things fairly tight because there's so much technology that's embedded in the developed world and in growing side the developing world, which is why we're continuing to see this next cycle of demand. So, but what does that do? That also drives up prices. So when you look at just the rising prices, it's important to understand the microchip. If you think about inflation, right? We've been in a very deflationary cycle because if we were to take this back, these rising prices, and you can see it with inventory in general, if we were to go back to the 1990s to today, we've seen a steady decline in prices. Even though we've gotten more computing power, there's been a steady decline in prices, especially when you compare it to CPU capacity and storage capacity. You're getting more for less. So even if the net price is still $100, you're getting way more power for $100 than you did even 3 years ago. And so now that is starting to catch up where there's only so much that can go down. Now the U.S. is talking about polysilica sanctions against Xinjiang, and this is a key component for solar and microchips in different capacities. So there's a lot of friction that's coming. So not only is this going to keep prices elevated and be a driver of this embedded inflation, if you look at just making up the cost side, but it's also the scarcity of chips, or the measure of availability of microcontrollers shows it sharply down amid a global supply crunch. So not only do we have this inventory issue, but we also have a supply issue, we have an inventory issue, and we have a price increase. Again, all of these things are going to lead to prolonged shortfalls and increases in pricing. And now when we turn to China precipitation, the last 2 years, and we covered it in our shows talking about the Three Gorges Dam, there has been massive flooding. And the last 2 years, there were pockets of massive floods leading to, the Yangtze River essentially being destroyed by basin being destroyed by constant flooding, and then there were pockets of significant drought. Now the drought has really expanded, creating a significant problem and a growing shortfall as you have essentially these massive shifts in water planting. So if you look at just where corn is grown and just how dry a lot of these areas remain, it is becoming a much bigger and bigger problem, which is why they're turning to the international market. So even though the U.S. is progressing fairly well, Brazil isn't, and there's significant droughts there. Europe isn't on the same level. Again, droughts. Russia, something similar. So when you look at some of this capacity, that's why they're going out and trying to pull in as much product and as much food as possible to try to protect pricing, to try to protect from inflation, and to shore up their food supply. But because there's so many people, because we're not used to not having bumper crops at this point, there's going to be this mini cycle almost, and it's going to result in just a significant amount of this pricing remaining sticky in corn and in grains in general, which is why even though it takes a while for some of this food pricing to increase, it's going to be sticky and it's going to be a bigger problem. And if countries panic, they'll try to build up their stores. And by doing that, they're going to create additional shortfalls within the system. And they're also trying to compete with these delivery times because when you look at manufacturing, supplier delivery times, they've finally peaked, but they really haven't come down. And that's what we keep talking about is every time there looks to be some normalcy, you have a COVID outbreak, you have a shortage of containers, you have a shortage of boats, you have a shortage of sailors. There's this constant, it feels like we're on this constant merry-go-round where we can't get off this constant trend that's keeping us elevated. And if you look at just where we are since 1951, you had a spike and then a fall. This is one where we think it's going to be much longer and stickier, just given, at this point in time, we have gone to asset-light inventories, at time delivery. So we were relying more and more on the supply chain that is now broken, and we've burned through inventories. We don't have the inventory capacity. So here we're sitting with price takers and still that massive reliance on the supply chain because we still haven't had a chance to catch up. And what is this doing? And when you look at some of these shifts, because we talk about emerging markets, we talk about inflation, well, at this point, many people have gone short the dollar because if you look at the carry trade, you look at the ability to short dollar, go into other currencies and invest in, when we talk about real rates, as we talked about on Friday, and we'll talk about again this Friday, you're starting to see some of these shifts in general. And this is why the positioning is very important when you look at how individuals are. Many people have the reflation trade on. So short dollars, long commodities, short dollars, long bonds, short dollars, what's another good one that we've heard? Short dollars, long other currencies, so a lot of individuals are positioned for short dollars, short dollars, long emerging markets, whether it's stocks or bonds. So you're starting to see this overweighting, which is why when we're sitting the DXY at about 91.80, it's important to appreciate where asset managers are, where leverage is. And then when we turn around and say, okay, well, what is the speculative short? Well, the net speculative positioning, if you look at just where the open interest is, you can see that it's at an extended level again, which is going to mean that there's a lot of people in the same position. And if you start looking at, inflationary fears, emerging markets having to buy, but at the same time, you're starting to see some cap in commodity pricing, some rollover in commodity prices. And it's important to appreciate because when people look at, lumber and they say, oh, well, lumber prices have normalized. It's like, okay, zoom out because you're zoomed in on a year. I was like, let's look at the last 15 years and where lumber prices are. And you've had some pullback, but again, it's just a pullback from all-time highs, not a pullback to normal, which is why there's going to continue to be this driving pace. Because when you look at the 2-year CPI inflation, it's important to understand that how do we factor in base effect? How do we try to consolidate it, show where it is? And here's when we look at the U.S. and just looking at the blended 2-year, you can just see where inflation is, how it's continued to go up, and how it's very unlikely we're going to see that pare back. But when we talk about emerging markets, you have to look at what happened after the FOMC with EM currencies, where EM currencies are down as much on the horizontal side as in the 2 days following the June 19th, 2013 Fed meeting on the vertical, which started the 2013 taper tantrum. So EMFX, so emerging market foreign exchange, is not sending a signal that what Powell said was dovish. And this is the conundrum that we're in, because when you look at the 10-year, and we'll talk about this in a second, but when you look at the 10-year, you had QE that outpaced Treasury issues in Q2, which is fairly rare. Now we're actually going to flip, and we're already starting to see some pressure in the 5-year. We're starting to see some pressure in the long end, that you're starting to see rates go up, prices come down. And that is going to put additional pressure on some of these currencies because inflation's already running hot. It's unlikely it's going to abate. It may not continue to rise at the same pace, but it's not coming back down, which means that they're going to have more foreign reserves, more dollars to back their currencies, and these are going to become a bigger problem, which is why when we look at the changes versus the U.S. dollar, 15th of June to 17th of June, you can see what has gotten stronger against the dollar, but also what has weakened. So when you look at some of these countries that are going to struggle against some of these currencies, they're going to have to go out and buy more dollars, buy euros, something to try to stop or to adhere to some sort of peg to protect against this inflationary fear. And then when you look at stimulus, so the fiscal and monetary combined side, we got this big thrust in GDP, but now it becomes a drag because you've pushed it all out at once, and now all of those consumer benefits, all of these things these transfers, they go away. and then they actually get reversed because you have a base effect going the opposite direction. And then the federal deficit and balance sheet expansion is going to become, again, that net pressure on just that underlying GDP, which is going to become a bigger and bigger problem. So now when we look at the reverse repo, which is printing over $750 billion on its way to $1 trillion going into quarter end, and this is why the Fed funds, they've started to pull forward when they're going to start tightening rates. But there are things they can do before increasing rates, like stop QE, cut QE. $120 billion a month. When banks are putting $1 trillion into the reverse repo is an inherent problem. That reverse repo is temporary. It comes back into the market. It is not a long-term solution. So we're going to have to start to see some adjustments, especially on the quantitative easing and bond buying side, which is where, when we start looking at deposit growth, has significantly outpaced the rate of loan production. This is where all of that money is coming from. These deposits that have gone parabolic have nowhere to go. Loans at U.S. commercial banks have either flatlined or fallen, which means that this money, these deposits, have to go somewhere, which has been the reverse repo, and it's going to continue to be used. And you can see the Fed balance sheet increasing, deposits and loans. This is where we continue to see these underlying overhangs, which is where we see it here, because here you can see the Fed purchases on treasuries. Fed purchases fully covering net issuance over the last quarter, a rarity in recent years and likely unsustainable given current deficit levels. So now you're going to see the Treasury increase. Q3 is going to be different, where Treasury issuance will go above QE. And again, this is going to put an underlying bid beneath where some of these rates are going to go. That is going to become a bigger and bigger problem for emerging markets, for borrowing, for lending abroad. And again, this is what keeps us cautious, where that global economy can shake out as some of these rates become an overhang and inflation starts to eat into some of the underlying growth.